Hello, and welcome to American Portfolio's overview of environmental, social, and governance criteria investing, or more simply referred to as ESG. Investment professionals are constantly on the lookout for new themes, strategies, and principles that can improve investment returns, reduce risk, and ultimately better the client experience. ESG investing is an area that has proven to accomplish all of this. ESG investing has been in the media for the past few years, but what is it and why should you pay attention? This brief video will answer your questions. Socially responsible investing has been around for decades. In the 1960s, investors who cared strongly about issues like civil rights or the war in Vietnam didn't want to own stocks that contradicted those values. In the 1980s, widespread divestment from South Africa contributed to the end of apartheid. Today's focus hinges on issues concerning human rights, accounting scandals, and climate change, just to name a few. ESG investing today looks at how a company treats all of its stakeholders in their business, not just the shareholders. While environmental and social issues have always been an important part of socially responsible investing, adding the governance factor was a game changer. Companies with strong governance policies, few conflicts of interest, and those that don't engage in a lot of controversial behavior tend to be strong stock market performers. When most financial advisors think of socially responsible investing, they think of all the stocks they'll be excluding. Traditionally, that meant alcohol, tobacco, firearms, and so on. Today's ESG investing strategies focus on including rather than excluding. In other words, searching for quality companies with commitments to values that not only align with the values of socially conscious investors, but also support long-term sustainable financial success. One of the biggest misconceptions concerning ESG investing is that it comes with a big give up in performance. In theory, it makes sense. If you're limiting your investment options, portfolio theory tells you that it should be much harder to get the same risk-adjusted returns. In reality, though, there's no evidence that ESG investing underperforms. In fact, it may even enhance returns. The MSCI KLD 400 Social Index has been around for almost 30 years and has beaten the Russell 3000 by about 20 basis points annually. Studies have shown that there's no difference in Morningstar rankings between ESG and non-ESG funds, and that ESG funds equal or beat the performance of non-ESG funds most of the time. Governance factors like transparent accounting or having few conflicts of interest may actually improve the return prospects of a firm. If you're not convinced that you should incorporate ESG investing into your practice, that's okay. You're not alone. A recent Morningstar survey showed less than 10% of advisors are highly interested in ESG investing, and a whopping 63% couldn't care less. If that's the case, why are we here talking about ESG investing? Well, that same Morningstar study also found that 70% of investors, your clients, are interested in ESG investing. For women, that number is at about 75%, and for millennials, it's 86%. Think of it this way: 63% of advisors, your competition, are not offering solutions to meet the desires shared by a majority of potential clients. That's a huge opportunity for advisors to be missing out on. While ESG investing is certainly not new, it's still misunderstood and underappreciated as a means to align investment goals with the client's values, and as a business tool for advisors to retain and attract clients. From one investment professional to another, I encourage you to learn more about this emerging industry trend. I hope you found this brief introduction to impact in ESG investing helpful. Feel free to reach out to me to further discuss this topic. I look forward to hearing from you. Thanks for watching.